Hello?
We're back today with some strategy, I guess. This is
Right.
going to be more strategy today.
This is more stock strategy. We'll talk a bit, since it's Monday morning. We'll get a little serious.
Yeah.
Yeah, I went down to Cup of Joe this morning and I've been thinking about, at the end of the day, as far as investments are concerned, it's great to have something that's growing over time, but as people get older, and even if they're not older, to get dividend. I mean, there's ways you can make money with stocks, putting growth first. Don't worry about dividends or interest. But the second way is to get growth and income, and also preferably growth income that's growing.
Okay.
So to me, owning stocks could be just like owning rental property.
Okay.
You know, you have $500,000 in a four-family unit, and you're picking up $30,000 a year in income. And over time, you can raise those rents over time. As that happens, the value of your property is going to increase. We can do the same thing with common stocks,
Okay.
and it's been done, and that's what I've done for clients.
So there's this kind of a problem, you say, with a cookie cutter approach. If people look at formulas and they say, like, well, when you're this age, you should have this percent in stocks and things, and this percent in the other stuff that will not be, going up and down the thing.
Well, great example. If you're 70 years old, I mean, the rule of thumb, which is so simplistic, it's idiotic. So if you're 70, you should have 70% of your money in fixed income, meaning CDs, meaning bonds, meaning preferred stocks, 30% in stocks. Okay.
So 70 and above.
Right. The problem with that is this. Buying bonds would be great, and I wish I could buy bonds, but interest rates are at such low levels. Anytime rates are so low, the prices of these bonds are substantially overvalued.
Okay.
Prices of preferred stock, substantially overvalued. Okay, but people don't realize that they have money in fixed income, and rates go up. Now rates are going to start rising. We haven't any kind of spike up in interest rates that's pretty dramatic. These prices of these bonds and preferred stocks are going to go down substantially. And what's worse, and to couple that, if you bought a CD, if you bought a CD today at 3%, you locked it up for 3 years, and then 6 months from now the CD rates are 4 and 5%. If you sold that CD, which you couldn't,
You'd lose money.
you'd lose money, because just like a bond. And on top of it, you're stuck with 2 or 3% interest. So that's the problem with owning fixed income, bonds, CDs, preferreds, when interest rates are so drastically low. Bonds have been overvalued for 3 or 4 years, period, relative to stocks.
All right. And then the idea that the Fed may raise interest rates and such 2 more times.
Possibility, but who knows? I mean, we may have a big bout of inflation.
Mm-hmm.
We may have something that shocks the system, that causes our bond prices to go down and interest rates spike up. You just don't know. All I'm saying is, you want to stack the odds in your favor. I'd rather hold something that is not overvalued.
All of a sudden, I'm thinking we're in Hunger Games here. May the odds always be in your
Right.
favor, right?
Right, that's
All
right. Now let me go back to this theory of 70%, 30%.
All right.
Now, if you are extremely risk averse, and you don't care if the prices of your bonds go up and down, and you need as much income as you possibly can get, that 70% strategy would probably be good.
Okay.
But you have to understand that you cannot sell these investments
The fixed ones.
at the worst times.
Yeah.
Okay. Now, problem that I have is when someone takes a stamp or a cookie cutter and says, boom, but if you're 75 years old, you don't need the income. You can live off the dividends and interest. You don't worry about volatility. And you've got a long-term perspective. I mean, if you need all that money next year, bets are off.
Okay.
But if you feel like you can just keep that and pass it to the next generation, there's no reason to own 70% in fixed income, especially in today's environment, where interest rates are low and prices of these things are substantially high.
Okay. But if
You're buying an overvalued asset, period.
all right. But if you invest a lot of it in stocks and things, it's more volatile, right? Like the possibility of losing it is higher. So
Okay.
so it tends to be like as you get older, you get a little bit more conservative about the investments, right? I mean, I'm just saying from the emotional point of view, right? But it's
It's-
not necessarily what you need to do is you need to talk to somebody like yourself, and it's not a cookie cutter approach. You need to tailor it to that individual investor.
Right, to their needs, and tailor to that. Because our first tenet, it's like you're supposed to know your patient. Well, I got to know my client. I got to know exactly what you need. I got to kind of get a sense as to your emotional, how much how much volatility you can take.
Right.
The thing with common stocks is they will go up and down. But if we have the highest quality companies, pay dividends, the dividends are growing every year, you can deal with a little volatility. Now, you're going to get the same volatility if interest rates rise. You're going to be very surprised. So, to me, I'd rather be in something that I know is undervalued.
Okay. Now I saw, this is just a little bit off the side here, but maybe, let's see, it was around like the turn of the year here, first week, second week, third week of January, somewhere in there, I was watching one of the finance channels, and they were talking about Boeing. And they said, oh, Boeing's really undersold right now, you should buy into Boeing, you know.
Oversold.
Oversold, I'm sorry, yeah, oversold. And so then, all of a sudden, Boeing kind of started moving up, and then you had these, two plane crashes, and Boeing went down, down, and they were saying, okay, maybe short it if you can or whatever, but then the company comes out and says they've got a fix for the problem that's going to keep the planes in the
Right.
air, and all of a sudden the stock starts going back up again. And then today I'm watching and it's going back down again.
Okay,
so
great
what-
example.
Yeah, what I'm asking, and all that, wouldn't there still be dividends paid regardless?
Yes.
So that would still
Yes.
be a smart move.
Guess what is probably a buy right now? Boeing.
Boeing, yeah.
Okay, now, I mean, obviously it's a terrible tragedy that happened.
Sure.
But Boeing, by and large, is the bellwether.
Yeah.
Boeing is Boeing, and Boeing has been a great stock all these years,
Yep.
and it's one that I never had the opportunity to buy. But probably this week, I would say we should be buying Boeing.
Yeah, so there's a good example of something that's going up and down, but still is going to be paying dividends, right? And would be a better deal, even with all the volatility that it's had. It would still be a better deal than a fixed income thing at a very, very low interest rate.
Right. Well, let me talk about specific things.
Alright.
So, for instance, if somebody looks at your Apple stock and say, well, you're only getting 2% dividend, well, it's also important to look at your original investment. Take your original investment, divide that dividend into your original investment. I calculated the other day, from the times we bought Apple, we're getting about a 4% dividend.
So that's decent. That's
Well,
good.
yeah, based upon our principle we put in, plus the dividends are growing every year.
Right.
It's
So-
just like,
so-
okay, so we talk about like bonds and preferreds right now.
Yeah.
Preferreds you probably can get about 6%.
Okay.
Okay, now we probably can get about 3% from our stock holdings
Okay.
when I combine everything.
All right.
About 3 to 4%, let's say. Again, I'd rather be in something that my income's going to go up over time. 6%, you're done. You're not getting any more than that.
Right.
You're going to get your principal back if you wait long enough, and if rates go up, you're going to go through a period where these things can be down to 10, 15, 20%. Same with the stocks. So that's just my theory. You had a question.
Yeah, I was just going to say, if you looked at the amount of, up and down volatility or whatever with something like Boeing, and you looked at the fixed income thing, you would come out better in the long run probably with something like Boeing. Right?
Absolutely. In the long run,
Yeah.
absolutely. I mean, Warren Buffett would tell you, common stocks
Yeah.
is the greatest thing for wealth accumulation
Yeah.
over time.
Now,
I mean,
I was going to say, I saw something with him yesterday or a couple days ago. He called Bitcoin double rat poison. Rat poison times 2. I thought that was pretty intense, I mean, I don't know that much about crypto. You may know more about crypto.
no, I don't.
But,
No, I don't.
Yeah,
But
yeah.
it's just like, the things that I'm reading, it's just like this thing is in the early stages and it's going to blow out.
Yeah.
But I don't know enough about it.
Well, apparently,
And plus, you don't get any dividends from it.
well, the amount of people that are invested in crypto, different cryptocurrencies like Bitcoin or whatever, has doubled in the last year.
Bingo.
So even though the value of Bitcoin's dropped 80%, I think it was 80%, right? There's still more people are investing in it.
Yeah.
And this particular commentator that was speaking yesterday that I was listening to said that it's the number one asked question on Google from the whole year last year. The number one question is, what is Bitcoin? So people are still asking what it is. And
think
trying
about
to
this. So if this happened over the last 12 months,
Yeah.
you had people rushing in, and there was a time that it hit a spike.
Right.
It peaked, people were rushing in, they're buying it, it's going up, and now they're getting hammered.
Yeah.
So that thing gets down low enough, and I understand what the hell it is,
Yeah.
then maybe it's time to buy some.
Possibly.
But the psychology, it's like it plays time and time. I mean, something as stupid as Beanie Babies.
Yes.
How much were people paying for damn Beanie Babies at one time?
I remember.
And how much did it take to make a Beanie Baby?
Yeah.
50 cents?
Yeah, less than
Yeah.
that. If you were, doing it in the sweatshops and, wherever. But yeah, I remember a friend of mine was paying, I think, between like $400 and $800 for the Princess Di Beanie Baby or something crazy like that when it first came out. You go to Goodwill now and you can find them for less than 5 cents a piece.
Yeah. I mean, it's just like the Tulip Mania.
Yeah.
We've seen it pretty much in virtually every commodity. Real estate, gold. Like right now, gold is undervalued.
Yeah.
I'm buying gold shares.
Right. Buying from the miners, right? We're talking about
The
mines,
miners.
the mines
And
miners.
I found one that's paying a 2% dividend.
There you go. That's not bad at all.
No, it isn't.
All right. So, in the past, the recent past here, you've even had some clients and such who have gone with that 70-30 thing
Yeah.
and lost a lot of money.
Yeah, I mean, I did a calculation the other day. I'm a client, got a $2 million portfolio. And when he was instructed to sell his 70% equities,
Not by you.
no, not by me,
Not by you.
another party, and sitting down, sold at X, now it's X plus plus. So in other words, sold at the bottom, regardless if they needed the additional income
They
or not.
were applying the cookie cutter
Boom.
approach. They said at 70 and 30,
Whatever.
you got to take this and do it
Take
this
it
way.
and do
So
that.
sell these stocks.
So we calculated it, and I came up with probably about $40,000 or $50,000 that was lost because it was sold at the bottom, and now if he wants to buy it back, it's going to cost him 50 or 60 grand. Okay, that is
The problem with the cookie cutter approach.
problem,
Yeah.
and it is not advice that you pay for.
So the best way to avoid something like that is to work with somebody like yourself who will actually take interest in the individual investor and see what they specifically need for themselves.
That's important. That's very, but the simplistic rule is never make a huge move at one time, unless you're a genius and you time it just right.
Okay.
Number one. Number two, never sell an asset. If you have two asset classes, I got stocks and I got bonds. Bonds are way overvalued. Stocks are moderate to maybe a little bit below value, but the thing is, stocks are better value than bonds.
Okay.
I wish I could buy bonds. I mean, if bonds were 6 and 7 and 8%, I'd be buying bonds.
But they're not.
Yeah, because in 1999 and the year 2000, interest rates were high as heck.
Yeah.
Stocks were on such a speculation on technology, it was time to buy treasuries. And we bought treasuries because treasuries were undervalued relative to stocks. Valuation is key.
Okay.
Key. Never buy things that are overvalued. Because I don't care how great, if you bought Apple near the peak,
Right.
and you say Apple's a great company, it's going to be great, but it was a bad time to buy it. I guess a couple things to take away from this is that I never make big bold decisions at one. So for instance, if I was going to ultimately take a client to 70% bonds, this is something that needs to be slowly moved.
Okay.
So in other words, you determine, well, I want to own that, I don't want to own this stock, I want to own this. but then sell it at the right time. Don't sell it at the bottom. You know, I looked at some of these portfolios, and they're selling things that are paying 3 and 4% dividends,
That's
just
crazy.
because it's a common stock.
Right.
So if we calculate, well, how much did you, when you paid for it, how much dividend yield are you now getting? Some situations it's 3, 4, 5%. Okay, then I'm going to buy a bond or a preferred that's going to pay me 6%. Don't make sense.
Yeah.
Don't make sense.
You're losing money, sure you.
So it's frustrating to me because I know what I've done over 20 years.
Yeah.
Because I've had this philosophy for 20 years. Easy. So that's about it for me. I'm going to put a little newsletter out. So if you're like more of a, you need to read it, watch the video, because this is something that I think is very important for people to know. Because my goal is to now show you an additional layer that we can do to generate more income. So at the end of the day, types of portfolios that I'm putting together are going to generate virtually just as much income. And you're not going to have to worry about interest rates spiking. But again, I'm going to go back to say there are portions of your portfolio that should be in CDs right now.
Okay.
That's it.
A little bit of both. But instead of it being a cookie cutter approach, it should be done individually.
Absolutely. Everybody's different. Just because I hit 60 doesn't mean, boom, immediately I can only hold to that theory. I can only have 40% of my money in stocks. And I can put 60% in bonds, even though bonds are overvalued.
Yeah.
Doesn't make sense.
Doesn't make sense.
As you can see, I'm very animated about this. Yeah.
All right. Very good. All right. Got any last minute good things to say to the folks?
I'm gonna be talking next about covered call writing, and that's gonna show you different ways that we can generate more income. And then other safe strategies.
Sounds good.
I mean, I want to protect capital, but I want to do it in a fashion that we're getting paid while we wait.
Very good.
Yeah.
All right. So next time, we'll see you then.
Take care.